Welcome back to Wealth Wisdom World, your #1 source for all things financial. Today, we're going to be venturing into the thrilling world of investing. If you've ever wondered about the power of stocks, bonds, mutual funds, ETFs, real estate, and even cryptocurrencies to grow your wealth, then this is the video for you. So buckle up, and let's take a deep dive into the strategies and mechanics of investing that could transform your financial future. Let's get started. Investing, at its core, is the act of allocating money or resources to an endeavor with the expectation of generating an income or profit. Whether it's buying stocks in a corporation, purchasing a rental property, or starting your own business, you're investing when you put your money to work for you. But why is investing so important? It's simple. Investing allows your money to grow. Unlike storing money in a traditional savings account, which offers minimal interest, investing provides the potential for substantial returns. This growth is crucial for goals like retirement, where you'll need a sizable nest egg to maintain your lifestyle. Understanding the different types of investments is key to building a diversified portfolio. Let's delve into some of the most common types. Let's take a closer look at stocks, one of the most popular and exciting forms of investment available to us today. When you purchase a company's stock, you're buying a small piece of ownership in that company. You become a shareholder, which means you have a stake in the company's success and potential profits. Each share represents a claim on part of the company's assets and earnings. There are two main types of stock, common and preferred. Owning common stock gives you the right to vote at shareholders' meetings and to receive dividends, which are a portion of the company's profits distributed to shareholders. Preferred stockholders, on the other hand, have a higher claim on dividends and assets, but they don't usually have voting rights. Investing in stocks has significant potential for high returns. For instance, if you had purchased Apple stock back in the early 2000s, your investment would be worth many times what you initially paid. This is because when a company performs well, its stock price can rise, and as a shareholder, you stand to benefit. However, stocks also come with higher risk compared to other investment types. This is because their value is subject to the company's performance and broader economic conditions. If a company underperforms or the economy enters a downturn, the company's stock price may drop. As a result, you could lose a portion, or even all, of your investment. For instance, during the financial crisis of 2008, many high-profile stocks saw significant losses as companies struggled with the economic downturn. Some companies even went bankrupt, leaving their stocks worthless. Despite the risks, investing in stocks can be a powerful way to grow your wealth over the long term. It's essential, however, to thoroughly research any company you're considering investing in. Understand its business model, analyze its financial health, and consider its potential for future growth. It's also a good idea to diversify your stock investments across different companies and sectors to reduce risk. Additionally, patience is key when investing in stocks. While the stock market can be volatile in the short term with prices rising and falling daily, historically, it has trended upwards over the long term. So, if you're investing for the long haul, short-term fluctuations should not deter you. Investing in stocks can be a rewarding venture, both financially and personally. Not only can you grow your wealth, but you can also become part owner of your favorite companies, sharing in their success. Let's dive a little deeper into bonds, which represent another key component of a well-rounded investment portfolio. In essence, a bond is a formal contract to repay borrowed money with interest at fixed intervals. When you buy a bond, you're essentially loaning money to the issuer. In return, the issuer promises to pay you a specified rate of interest during the life of the bond and to repay the face value of the bond, the principal, when it matures, or comes due. There are three primary types of bonds. Corporate bonds. These are issued by companies. Corporate bonds often offer higher interest rates, or yields, than government bonds because companies have a higher risk of defaulting. Municipal bonds. These are issued by states, cities, or counties and their agencies. The interest earned from these bonds is often exempt from federal income tax and may also be exempt from state and local taxes, making them particularly attractive to investors in high tax brackets. Government bonds. These are issued by the national government, and in the U.S., they come in two forms: treasury bonds and savings bonds. They are considered the safest bonds because they are backed by the full faith and credit of the U.S. government. Bonds are generally considered safer than stocks for a few reasons. First, bondholders have a higher claim on the issuer's assets than shareholders do. In other words, if the issuer goes bankrupt, bondholders are paid first. Second, bonds provide a fixed interest income, also known as the coupon rate. Regardless of how well or poorly the issuer does, as long as it doesn't default, it's obligated to pay you interest. This makes bonds particularly attractive to income-focused investors. However, the flip side of safety is that bonds have lower return potential than stocks. The issuer agrees to return the principal and a certain level of interest to you, but no more. Thus, when companies do exceptionally well, bondholders don't see any extra profit. Finally, it's important to note that while bonds are generally safer than stocks, they are not without risk. If the issuer defaults, you could lose your investment. Furthermore, bonds are subject to interest rate risk. When interest rates rise, bond prices fall because new bonds are issued at the higher interest rates, making existing bonds less attractive. Despite these risks, bonds serve a vital role in a diversified portfolio by providing steady income and a cushion against the volatility of the stock market. Let's delve deeper into mutual funds, a popular investment choice for many investors. A mutual fund is an investment vehicle that pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Each investor in the fund owns shares, which represent a portion of the holdings of the fund. There are various types of mutual funds, including equity funds. These are mutual funds that primarily invest in stocks. They can be further divided into a number of categories based on company size: small cap, mid cap, large cap, investment style, growth, value, blend, and geography: US, international, emerging markets. Fixed income funds. These are mutual funds that invest in bonds or other fixed income securities. They are often considered safer than equity funds and generate regular income for investors. Index funds. These are mutual funds that aim to replicate the performance of a specific index, such as the S&P 500. They offer broad market exposure and have lower fees than actively managed funds. Balanced funds. These mutual funds invest in a mix of equities and fixed income securities, balancing the aim for appreciation with the goal of income generation and capital preservation. One of the main advantages of investing in mutual funds is diversification. As they say, don't put all your eggs in one basket. With mutual funds, your money is spread across a wide array of securities, which can help minimize risk. If one company in which the fund has invested performs poorly, it's only a small part of your total investment. Additionally, mutual funds provide access to professional money managers who make investment decisions on behalf of the fund. This can be particularly valuable for investors who lack the time or expertise to manage their own portfolios. However, it's important to be aware that mutual funds come with fees, the most common of which is the expense ratio. This annual fee, expressed as a percentage of your investment, covers the costs of managing the fund. Some mutual funds also charge a sales commission, also known as a load. Furthermore, while diversification can help reduce risk, it doesn't guarantee a profit or protect against loss in a declining market. And while professional management can be a boon, it doesn't guarantee success. Despite these considerations, mutual funds can be a valuable part of an investment portfolio, offering diversification, professional management, and a range of investment options to suit different risk profiles and investment objectives. Exchange-traded funds, or ETFs, have become a popular investment vehicle in recent years. Similar to mutual funds, ETFs are investment funds that pool money from many investors. However, while mutual funds are only bought and sold at the end of each trading day at their net asset value, ETFs can be traded on an exchange throughout the trading day, just like individual stocks. This characteristic gives ETFs price flexibility, which can be an advantage to the investor. You can buy and sell ETFs anytime during trading hours at the current market price, giving you more control over the price you pay or receive compared to a mutual fund. Most ETFs are passively managed and aim to track the performance of a specific index. This could be a broad market index, like the S&P 500, or a specific sector index, like technology or healthcare. Due to this passive management, ETFs typically have lower expense ratios compared to actively managed mutual funds. There are also ETFs that track commodities, like gold or oil, bonds, or a basket of currencies. This gives investors a way to gain exposure to a wide variety of asset classes. Additionally, ETFs are known for their tax efficiency. Because of the in-kind, Creation and redemption process of ETF shares, which typically involves exchanging securities for ETF shares, rather than buying and selling securities. ETFs can often avoid triggering a taxable event. However, just like any other investment, ETFs come with risks. The ETF's price can fluctuate throughout the day, and there is no guarantee it will match the performance of the index it's designed to track. Furthermore, while ETFs generally have lower fees than mutual funds, you may incur brokerage commissions when buying and selling ETF shares. It's also worth noting that while ETFs offer diversification, this does not guarantee a profit or protect against a loss. As with any investment, it's important to consider your own risk tolerance, investment goals, and other factors before investing in ETFs. In summary, ETFs provide a versatile and accessible way for individuals to diversify their portfolios. They offer the flexibility of stocks, the broad diversification of mutual funds, and often come with lower costs. However, like all investments, they should be chosen carefully based on your individual circumstances and objectives. Delving deeper into real estate, we can see that it presents an entirely different kind of investment opportunity. Real estate investment involves purchasing physical land or property. This could include residential properties, like houses and apartments, commercial properties, like office buildings and shopping centers, or rental properties, either residential or commercial. This type of investment is often seen as a good way to diversify an investment portfolio beyond traditional securities. There are several ways to invest in real estate. Home ownership. The most common real estate investment is home ownership. While not often thought of as an investment, the potential for property value appreciation over time can result in substantial returns. Additionally, owning a home can provide a hedge against inflation. Rental properties. These can be residential or commercial. As the owner, you earn rental income from your tenants. Ideally, the rental income will exceed your expenses on the property, resulting in a profit. Also, like home ownership, rental properties can appreciate in value over time. Real estate investment groups, REIGs. These are a type of mutual fund for rental properties. If you want to own rental real estate without the hassle of being a landlord, a REIG is a good option. In a typical REIG, a company buys or builds a set of apartments or condos, then allows investors to purchase them through the company. Real estate investment trusts, REITs. These are companies that own, operate, or finance income-producing real estate. REITs offer a way to invest in real estate without having to own, operate, or finance properties yourself. Real estate crowdfunding. This is a newer way to invest in real estate, where you can invest in private real estate offerings through an online platform. Real estate investing offers several benefits. These include potential appreciation in property value, income from rentals, and tax benefits. In addition, real estate can be a good way to hedge against inflation, as property values and rental income tend to increase when prices rise. However, real estate also comes with risks. Properties may lose value, and income from rental properties may not exceed expenses. Real estate is also less liquid than stocks or bonds, making it harder to convert to cash. Whether you're considering residential, commercial, or rental properties, it's important to do your research, perhaps seek advice from real estate professionals, and consider your financial situation and tolerance for risk before investing. Cryptocurrencies represent a relatively new frontier in investing, and they are known for their extreme volatility but also for their potential for high returns. A cryptocurrency is a digital or virtual currency that uses cryptography for security. The most well-known cryptocurrency is Bitcoin, but there are now more than 5,000 different cryptocurrencies in circulation. Here's a bit more detail on a few prominent cryptocurrencies. Bitcoin, BTC. Launched in 2009, Bitcoin was the first cryptocurrency and remains the most well-known and valuable. It was created by an unknown person or group of people using the pseudonyms Satoshi Nakamoto. Bitcoin introduced the concept of blockchain, a decentralized ledger of all transactions that is the core of most cryptocurrencies. Ethereum, ETH. Launched in 2015, Ethereum is more than just a digital currency. It's an open-source platform that enables developers to build and deploy decentralized applications, DApps. Its native currency, Ether, is used primarily for two purposes, as a digital currency like Bitcoin, and is used inside Ethereum to run applications and even to monetize work. Ripple, XRP. Ripple is both a digital payment protocol and a cryptocurrency. It was launched in 2012 and is now used by some major banks as part of their payment systems. Cryptocurrencies have several potential benefits. They provide a way to transfer funds directly between two parties without needing a trusted third party like a bank. They're also accessible to anyone with internet access, providing a way for people in unbanked or underbanked regions to access financial services. Investing in cryptocurrencies can potentially be very profitable. Due to their volatility, prices can increase rapidly, leading to high returns on investment. However, the same volatility can also lead to significant losses. Cryptocurrencies are also known for their high level of risk. They're highly volatile and can be prone to fraud and hacking. Also, because they're relatively new, they're not as well understood as more traditional forms of investment, and their legal and tax status can be complex. Furthermore, the value of a cryptocurrency is entirely speculative. Unlike a stock, which represents ownership in a company, or a bond, which represents a loan to a company, cryptocurrencies don't represent a claim on an underlying asset. In conclusion, while cryptocurrencies represent an exciting new frontier in finance with the potential for high returns, they also come with a high level of risk. As with any investment, potential investors should carefully consider their risk tolerance and do thorough research before diving in. Before you dive into investing, it's important to define your financial goals, risk tolerance, and time horizon. These factors will guide your investment decisions and help you create a diversified portfolio that aligns with your financial objectives. Another critical part of investing is understanding the power of compound interest, often hailed as the eighth wonder of the world. Compound interest means you earn interest not only on your initial investment but also on the interest that your investment has already earned. Over time, this can lead to exponential growth. Getting started with investing may seem daunting, but it doesn't have to be. There are plenty of resources available to help, from books and online courses to financial advisors and robo-advisors. Start with a small investment, continue to learn, and gradually build up your portfolio. Remember, investing is a marathon, not a sprint. It's about consistent, long-term growth, not quick wins. Stay patient, keep learning, and keep investing. Your future self will thank you. That wraps up our introduction to investing. If you found this information valuable, please like this video and share it with your friends and family. They might thank you one day when they're reaping the benefits of their investments. Stay tuned for our next episode, where we'll delve deeper into each type of investment. Until then, keep growing your wealth, wisdom, and world. Remember, you're not alone on this journey. We're with you every step of the way.